You're in the water loop.
Waterloop is made possible in part by grants from Spring Point Partners and the Walton Family Foundation. Hi, this is Travis with Waterloop. Water conservation is very important to me, and I bet it is to all of you. That's why I use High Sierra shower heads in my house, and I'm so happy to have them as a supporter of this podcast. High Sierra carries the EPA WaterSense label for efficiency and uses 40% less water than conventional low-flow shower heads. 40%. The model I have uses just 1.5 gallons per minute. And because of their unique nozzle design, it's patented. Nobody else has it. It maximizes efficiency of water and energy use, but doesn't sacrifice on performance. You still get a powerful shower. Use promo code LOOP20 for 20% off at highsierrashowerheads.com.
Waterloop.
The Waterloop podcast is sponsored by Flume. It's the perfect device for tracking your home's water use in real time on your smartphone. It's so easy to use. You just attach a small device to your water meter using a band, the same way you put a watch on your wrist. Then you connect to Wi-Fi, you download the app, and you're up and running. It's as simple as that. You don't need a plumber. You don't need to cut into any of your pipes or water lines. Very easy to set up. Then you can set water budgets, how much you want to use each day or week. It'll keep track of that. It'll tell you what's going on in your house with water use minute by minute. It'll send alerts to you if there's excessive water use or if it suspects a leak. In fact, when I installed Flume at my house, it told me almost right away about a leak. I was losing 1 gallon of water every 6 minutes. I'm honestly not sure when I would have found that without Flume. You can use promo code WATERLOOP for 10% off at flumewater.com.
You're in the water loop.
Welcome to Waterloop. In this episode, going to talk about one of the biggest challenges out there for water and environment. That's the funding and financing of projects and where those dollars come from. Really pleased to be joined by Eric Letsinger, the CEO of Quantified Ventures. Eric, thanks so much for coming on the podcast.
Oh, thanks, Travis. Looking forward to a good conversation.
Yeah, so I'm really intrigued to talk to you kind of about some of the new innovative, creative financing that's out there and what you all have been up to. Could you set the stage a little bit and talk about kind of the challenges with how environmental projects were and still are traditionally financed that kind of ended up leading you to your approach?
Sure. I mean, listen, we have an endless inventory or list of projects that the humans in this space would like to get on the field. Funding is always a problem. And when nickels and dimes of funding are scarce and expectations are high, we tend to move forward with more business as usual and safe solutions. And given the demands of public sector leaders now in the wake of with climate change and 4,000 other plate tectonic shifts and dwindling budgets, we're going to have to innovate up this mountain, if you will, and that's asking a lot of our public sector leaders, right? Go ahead and innovate up that giant mountain. There's not a lot of upside for innovation in the public sector. I've spent a third of my career running municipal agencies, and there's a lot of downside, right? And innovation doesn't always work. And so with a lot of the ways that we currently pay for infrastructure, water infrastructure, environmental projects, we pay for, we the government, we pay for things up front, and we typically hope for the best. And so the simple notion that we've leaned into is how can we enable our government leaders to more efficiently pay for innovation by buying the outcome at the back end as opposed to paying for everything on the front end and hoping for the best.
Interesting. Well, could you talk a little bit about your background? I thought it was interesting that you've kind of been in a couple of the different key spaces for this. You mentioned working in the public sector for a third of your career. I think you've got another good blend when you look at your background.
Yeah, I only recently learned that there was a term for this, but apparently I'm a tri-sector executive, which sounds fancier than it feels. And so I've spent a third of my career in the public sector, a third of my career in the nonprofit sector, and a third of my career in the private sector, and have enjoyed each one of them. And I generally feel like each one of those three sectors is incredibly good at something and incredibly lousy at something. And so the work that I have enjoyed the most and seen the most impact from over my career has been when each one of those three sectors is working on a challenge where each of those sectors gets to bring what they're super duper great at and leave behind perhaps what they're super duper lousy at.
Yeah. Well, I know one of the things that the public sector struggles with, and you just kind of alluded to or talked about, is this idea of risk and innovation and being creative, right? They don't really usually have the flexibility to do that. They're under certain laws and regulations, and they've got to deliver, and there's not a lot of room to take risk. So I know that you kind of pioneered this approach in DC. That was the first project, right? So could you tell that story?
Sure. That was a really fun one, and it was a real treat to work with leadership at DC Water at the time. On this, they were under a consent decree to address their combined sewer outflow challenges, and they were staring down the barrel of big decisions as to whether they're going to spend $2.6 billion on more gray infrastructure or whether they're going to try to spend some of that on green infrastructure. And so let's think about those two choices in the spirit of business as usual or innovation, which I realize is overly simplistic, but and so meaning the gray infrastructure, the tunnels, they know those will work, 2.6, and they're good at building them. And matter of fact, they built the first one, and it was on time and on budget. Like, go government, go, on time and on budget, $1 billion capital project.
And it's been tremendously successful. I mean, it's done what they set out for it to do. Yeah,
exactly. So why change? Well, why change is this innovative solution. At the time, George Hawkins, the general manager of DC Water, was quite enamored with the positive externalities associated with green infrastructure, meaning there are environmental benefits, there are health benefits, there are workforce development benefits, there's a lot of outcomes that are associated with green infrastructure that are less so on the gray infrastructure side. Okay. But back to your risk question, the risk profile, perceived or real, of green infrastructure, meaning, oh, wow, let's see, if we were to build 350 acres of green infrastructure, will that address the CSO challenge in the same manner with the same kind of level of confidence that the gray infrastructure tunnels would? Don't know. Why? Because nobody's ever gone all in with that kind of solution, right? So who wants to be first in the public sector? Literally nobody, right? And so somebody's got to figure out a way to de-risk that choice so that it becomes a rational choice for the government to choose that innovative solution over business as usual. In situations where there's an appetite for the government to actually consider that innovative solution. Which was present at DC Water. So at the end of the day, that's all we did, is just tip the scales. And so how would they have normally paid for this? Municipal bonds. So let's start there. Let's see if we can. Let's not invent something new and scare the capital markets to death and terrify everybody along the way. Let's build off of what we already are using. So we worked backwards with the municipal bond and said, how can we create a situation where the bond buyer for this bond to fund the green infrastructure shares in some of the performance risk of the green infrastructure? Because it may or may not work, thus the word innovation, right? And so to do that, you've got to figure out what the bond buyer would be betting on, if you will. What's the metric? What's the outcome metric that that investor would be due diligencing the risk of that occurring, and B, like, how do we, something we can measure and then say, yes, it worked in a super duper way or in a super duper lousy way, and therefore, bond buyer, here's your return. So once that work was done, and we came up with a flow in the sewer metric that reasonable people, the outcome we wanted was a cleaner Potomac River. We found a good proxy metric where reasonable people agreed that if you control the flow in the sewer, you're going to end up with a cleaner Potomac River. Okay, so once we had the metric, then we were able to model that and get that into a normal curve with some confidence intervals. And then that became a simple predictive model of how well the green infrastructure would perform with that gradation, that climate, that soil composition, all the factors. And then all we did was layer interest rates over that normal curve, meaning we think it's going to perform in the middle of this normal curve, right? And therefore, we'll make that interest rate whatever the normal interest rate would have been at that particular time, floating into plain vanilla municipal bond. However, in the far right tail, which is the overperform, meaning if in 5 years we open up the magic box and we learn, hey, this thing did twice as good as we thought it was going to do, which would be fantastic news because DC would save about $175 million. Let's make the interest rate for that far right tail be twice as much, right? Because if the city is saving $175 million, happy to pay a bonus payment out to the bondholder of a few $1 million. And then on the downside, in exchange for that upside wonderfulness to the investor, where they're both sharing in that upside, on the downside, what if it doesn't work? And let's just say it doesn't work. Green infrastructure totally doesn't work. It's a 0 out of 100 fail. Then that interest rate would be, call it 0%, right? And so, and then now what just happened? The city's disappointed because they've learned green infrastructure doesn't work in their city. And they haven't, instead of them taking the full financial hit of that, they have shared that downside with their bond buyer. Suddenly their interests are aligned with their bond investors, as opposed to how standard municipal bonds work, which is a zero-sum game. You argue over the interest rate, somebody wins, somebody loses. And so now you've got a partner in your investor who actually wants the good outcomes to actually occur.
So in that respect, this environmental impact bond approach, there's a greater degree of risk, but there's a greater degree of reward. Is that fair to say? Yeah.
And you can structure them one way or the other. It's interesting. We're in the process of structuring one in Buffalo, which is the inverted, meaning the more and there's investor appetite for all these packages. And so the one in Buffalo, the environmental impact bond, is the more positive outcomes that are generated, the less return the investor makes.
What would incentivize an investor to go with that? I'm kind of curious in some of the different motivations here, of the different formulations.
Right. I think the appetite for an environmental impact bond that was structured in the inverse way that the DC Water one is our more family office, philanthropic, meaning I used to grant fund for these kind of projects. I now see a way to actually invest to make these. I was willing to grant this out completely. I'm now willing to get a return on it. I'm thrilled that we're even talking about my getting a return on it. And I'm willing to actually have my return be inversely proportionate to the outcomes that are generated for that particular community.
Very, very interesting. I'm curious, how the returns compare for this approach to the other, municipal bonds. How many have been done? What's the scope of work so far of this? So it's kind of been going on for 4 or 5 years. What's the track record?
Let's see here. So the track record. Well, let's see here. We've got to segment them out into the different kinds. Okay. And maybe there's one more that's worth putting on the table. So we just closed one of these with the city of Hampton, Virginia. And this one was a really interesting environmental impact bond because it was it didn't have the elements of tying the return on investment directly to the performance of the green infrastructure projects. However, what it did do is it bridged the gap between what a green bond does and what an environmental impact bond has typically done. Meaning, a green bond is, as we know, right? And I'm not a hater of green bonds, but it's about intent, right? I'm Eric Letsinger. In 1 year, I am going to run a marathon, and I intend to run a marathon, and here's my note that I got from my trainer. I haven't started training yet, but I'm going to start next week, and here's my note from the trainer, right? And I'm a good bet, right? And then so I'm the green bond, right? I'm intent, right? Like that's something I plan to do. If you buy this bond and I don't run the marathon, there's no recourse. But that's what I intend to do. So the environmental impact bond that we did in Hampton actually took the notion of that green bond and said, let's do three things. Let's formally predict the outcomes that will come from this project. And number two, let's agree to formally evaluate whether those outcomes actually happen or not. And number three, agree in our disclosure agreements for this particular bond, agree that we will publicly announce the realization or non-realization of the outcomes associated with this resilience project. And so that particular model is really efficient, and it takes the notion of a green bond and starts to satisfy the growing demand of ESG investors, who obviously the demand for green bonds in certain markets is very high, but many of those investors are saying, yeah, but did I get the impact? Right? I understand the intent, and that was good, and that was a good start, but now I'm wondering 2 years later, like, what happened? Did Letsinger run that marathon? And so the environmental impact bond is starting to satisfy that demand for project the impact, quantify it, meaning through engineers, not by somebody filling out a form. And then number two, committing to that rigorous evaluation. And number three, publicly reporting on those outcomes.
Okay. And I mean, you guys have picked up steam, it seems like, from me kind of watching from afar and noticing more stuff on social media and stories in the regular press and everything. You know, it started with DC. I think you guys did one in Atlanta, Hampton, Virginia, like you mentioned. There's Louisiana, and I want to talk about those other ones a little bit. I think there's some stuff stirring in Memphis and New Orleans, and so it's kind of having that expansion that you'd hope for, right?
Correct. And it's been interesting to see where these go. So we started, I would say 80% of our work is in water in some way, shape, or form. All of our financial structures are about monetizing and selling outcomes, and trying to flip that buying process. One that's really interesting to talk about, Travis, that you may find interesting, is in our agriculture work. Would it be okay if I unpack that one?
Absolutely.
Yeah. So after the DC Water Environmental Impact Bond closed, we had real interest in taking that stormwater management model and converting it and seeing if it was applicable in the water quality space in the Midwest, where we've got a lot of phosphorus and nitrate coming from upstream farms, right? And so then the water authorities downstream are having to make significant investments in their treatment facilities. Can we use this model to address some of those challenges? We ran after that for about a year, and in Iowa, and the model didn't quite pencil the way we thought, meaning all the numbers didn't line up. The savings wasn't good enough to actually make something scale and become replicable, until you started to look at some of the practices that we were paying farmers to profitably build. And it turns out 3 of the 5 of them sequestered carbon. So that's when the light bulb went off in our brain saying, hey, listen, we're typically doing these transactions based on one outcome. What if we could start what we refer to as stacking outcomes, meaning one activity, multiple outcomes, sell those outcomes to different entities who may or may not care about one another. But if they can buy them and subsidize each other's costs to the point where each one was satisfied with the price of their outcome, if we could figure that model out. So we ran after that. And so we now have a highly scalable model that is expanding now outside of Iowa and into Ohio and Illinois and the 4 other states in that region. We're doing this all in partnership with the Iowa Soybean Association, and where to give you the punchline of what we ended up developing is we now pay farmers in those states to profitably, meaning they make money. So we're no longer just giving a grant to cost share or make it complicated. Like, here's a way for farmers to make money. Go ahead and here are the 5 practices. Go ahead and build those things, right? And then you're done. The farmers are done. And then we sell the carbon offsets to corporations who have made big shareholder commitments, and they're thrilled to be buying carbon offsets that actually come from their supply chain, as opposed to other sources. And that why? Because it makes their supply chain more resilient. And then we sell the water quality benefits to municipalities, states, and to the USDA.
Mm. And so that's awesome. We're talking about like cover crops, buffer strips, kind of that kind of no-till farming, or yeah.
Correct.
I got 3 of the 5.
You got 3 of the 5. Yes, you did.
I'm afraid to try to keep going and ruin my batting average there. But yeah, that's awesome. Especially because, like you said, a lot of times with the agriculture challenges, it's just giving grants to try to offset. But if farmers can actually then add a profit on top and make that money, especially, we know that they're hurting in a lot of ways. So that's fantastic. I think there was some other unique aspect of the Atlanta bond. Could you talk about that one?
Yeah, absolutely. So the DC Water Environmental Impact Bond, that was the first of a kind. Got a lot of fanfare, and it created a lot of good discussions with a lot of municipalities. That was a privately placed bond. What does that mean? It means at the end of the day, it wasn't. We sat in a conference room with investors and worked out the transaction in such a way, because it was the first of a kind, and we needed to do it together, right? And we did, right? So that privately placed bond. Now that's at the end of the day, that was a great win for the market. Got a new financial product on the market for water authorities to consider. That's fairly inefficient, and so the question when Atlanta stepped up and said, "Hey, listen, we want to do one of those things," and the innovation that they were willing to tackle was, can we structure one of these environmental impact bonds and then issue it publicly? Meaning we don't have to sit in a conference room and have long conversation and eat bad sandwiches. So that was the success of that environmental impact bond. It was phenomenal to work with the city of Atlanta and also with the Department of Watershed Services. And they were really, really great partners because, I would say even up to the last day when it actually got sold, none of us knew whether that was possible, if that makes sense.
Yeah, sure. Well, I mean, given the coronavirus of the past 10 months or so, I would love one of those conference room with crappy sandwich lunches, just to sit around with people and talk, man.
Bad sandwiches sound pretty good.
With friends and coworkers,
with humans in the same room, right?
Also, just wanted to ask about the Louisiana one that I think involved wetlands. Just kind of what that bond looked like.
Well, let's do two projects we're talking about in Louisiana, and a potential third in Baton Rouge coming up. But Louisiana, that project started with the simple notion of the state of Louisiana is losing a football field of coast coastline every nanosecond, right? And so, and we know that building more nature-based solutions off the coast, i.e., wetlands, will slow down the degradation of that coastline. With the Blue Horizon funds from the BP oil spills, there's money there, and there's projects, and there's the normal delay of projects, meaning whatever you do today will cost you less because that degradation is happening on a nanosecond by nanosecond basis. So, the simple spirit of what we were trying to do there was to finance the development of these wetlands off the coastline of Louisiana, and then have the metric be, did we slow down the degradation of the coastline against what it would have normally been eroding to? So that was a really fun project to work on. I will say there's another really exciting project that we've that actually launches this month in the city of New Orleans with with Finance New Orleans, which is the old housing finance agency, who through great leadership from a gentleman named Damon Burns, who runs that agency, learned about the DC water and the environmental impact bonds that have been going around the country, and had the really interesting idea of seeing if we could combine that with a mortgage product to actually push out to private residents in New Orleans to incentivize them to build resilience practices, i.e. green infrastructure, on private land, and embed that product, an outcomes-based product, with a mortgage product. And that is, for people like me, that's like nerd heaven.
Yeah.
And a great
I'd like to sign up for that myself,
right.
Please. Yeah.
That's right. So be on the lookout for that getting rolled out here at the end of January.
Okay. Very cool. You mentioned about how much of your work is in the water space. I know you do are in some other areas, but why is it that water is such a good fit? Why is it such a good fit for these environmental impact bonds and this type of innovative finance?
That's a good question. Because I don't think there's not been a lot of innovation in how we pay for water projects or things that touch water in a long time. So it was ripe. And then number two, what makes this water projects that have the word water in it, create a lot of outcomes, various outcomes. And that is meaning outcomes that we can price, we can measure, we can predict, and we can sell. And if we can sell it to people who, with a value proposition of, if we can sell those outcomes to healthcare payers, in the health systems, whether it's Medicare Advantage plans or Medicaid MCOs, who can buy outcomes from water-related projects, we all know intuitively and through evidence that water-related projects create health outcomes, environmental outcomes, workforce development outcomes, and yet we hamstring these water authorities and say, you pay for all of it, right? What? Right. So what do that? And they're going, well, I got to find more nickels and dimes in the sofa. Yeah. And so the water industry is so ripe for this concept of slicing and dicing the outcomes of projects and having other parties pay for those outcomes, not on the upfront, but when those outcomes are delivered to their doorstep by them doing nothing. And what makes all this possible is the growth of impact capital. And because impact capital is a source of capital, it's growing at 23% a year, it's massive. We don't need to measure it anymore. It's not going anywhere because it's tied to the intergenerational wealth transfer. And let's bring that capital that wants to get connected directly with outcomes. Meaning they don't want to just invest for the sake of investing. They want to know what their investment is yielding in terms of impact. And so it is the right time for the water industry to get to know that capital, because that capital is looking for exactly what the water industry produces.
Yeah. Man, it's exciting stuff. That's awesome. As someone that's worked in water for a while myself, yeah, I'm excited by what's happening here and what you guys are doing. That's terrific. Sounds like a bright future, and that you're going to be busier and busier as days and months and years go by here, which is a good thing. I definitely look forward to digging into some of these projects that we talked about today, and talking to people in Iowa and talking to people in Louisiana, just about how these have worked on the ground. But Eric, thanks a ton for your time and for talking about what you're doing. Absolutely.
Let's call this the beginning of a long conversation, my friend.
Absolutely. All right. Take care.
Thanks, Travis.
Waterloop.
Thanks, everyone, for listening to today's episode. A special thanks to Waterloop supporters Spring Point Partners and the Walton Family Foundation. The Waterloop podcast is sponsored by High Sierra Showerheads, the smart, stylish way to save energy, water, and money while enjoying a powerful shower. Save 20% with promo code WATERLOOP at highsierrashowerheads.com. Waterloop is also sponsored by Flume, the smart water monitor that tracks your home's water use in real time and provides data on your smartphone. Save 10% with promo code WATERLOOP at flumewater.com. If you like Waterloop, please subscribe to the YouTube channel or your favorite podcast platform. Follow us on social media and visit waterloop.org to sign up for updates.
Waterloop, Waterloop, Waterloop.